Thank you, Mr.
Thank
Chairman.
you, Mr. Chairman.
Thank you. So, Chair Powell, the Fed released its updated economic projections last week, and I appreciate your summary, but I want to look at the trend lines here. The Fed's outlook on inflation, the labor market, and GDP growth have all gotten worse. Compared to your economic projections in December, the latest numbers show that the Fed is now projecting higher inflation from 2.5% in December now to 3.1%. Higher unemployment from 4.3% to 4.5%. Lower economic growth from 2.1% projected just 6 months ago to 1.4% that you're now projecting. Chair Powell, what has changed in the last 6 months that has caused the Fed to forecast substantially higher inflation, somewhat higher unemployment, and lower economic growth than you did in December?
So some of it is just taking signal from data reports that we've seen. Some of it is people working in the possible effects in the short term of tariffs. We have no view on the wisdom or the longer term effects of trade policy. It's not our job. And by the way, I should add, our forecasts are generally, and in this case, are very, very similar to what outside forecasters are calling for.
I understand that. I'm just using you as the gold standard here. I know it's consistent. But you mentioned tariffs as one of the things that has changed over the last 6 months. You know, Donald Trump has become president and the economy has headed down. Not only does the Fed data now show slower growth and higher prices this year, it sees slower growth and higher prices over the next 2 years as well. And the Fed sees no longer-term boost to the economy or drop in inflation. In other words, no upside to Trump's chaotic tariff war or his other economic policies. So let's talk for just a minute about what's under the hood of the Fed's economic forecast. Chair Powell, I know a lot of different factors influence the trajectory of interest rates. Is one of those factors how quickly the federal debt grows relative to the growth in the economy?
Not directly, no. We don't look at that as a factor that helps us set monetary policy.
So you're not watching the ratio between the amount of the federal debt and the growth in the economy?
No.
How fast the debt is growing and how fast the economy is growing? I think I have quotes from you saying last year, quote, we don't need to pay the debt down. We don't need to balance the budget. We just need the economy to grow faster than the debt. Are you saying something different from that now?
No. When asked and pressed, I pretty much always say the same thing as my predecessors, which is that we're on an unsustainable path. I would not say, though, that we do. I will say this: we do not look at federal financial policy and deficits as something that affects our month-to-month monetary policy decisions.
I'm trying to get the overall projection of what happens in the economy. So, for example, I think you have made the point that if we spend on things like childcare that can boost labor participation and GDP, that may be a time when you offset the debt that you incur to do that. But if there aren't investments like that and we are simply running up the debt, what's the impact of increasing the national debt? So I understand that you don't comment on fiscal policy, but it does affect your job, which is keeping inflation under control and also maximizing employment. If certain policies would materially drive up the national debt and increase the debt to GDP ratio over time, could that make it more likely that we would see inflation, all else being equal?
I mean, theoretically, sure, fiscal policy can add to inflation, but that's again, that's really not something we comment on. We try to stay away from fiscal policy.
I understand you don't comment on it, but I do appreciate your acknowledgement of the math here. You know, the Joint Committee on Taxation projects the one big, beautiful bill would increase federal deficits by $4.2 trillion. According to analysis by the Congressional Budget Office and the Yale Budget Lab, the bill raises the debt to GDP by 24 percentage points. It slows economic growth, it increases inflation, and it reduces real wages. So 2 of Trump's signature policies, his tariffs and his tax bill, will increase costs for American families. When America borrows money, it should be for investments that Americans need, like investments in childcare or housing or healthcare that would actually boost economic growth and lower costs. America should not take away healthcare from millions of people who need it and then borrow trillions of dollars just so that a handful of billionaires and giant corporations can get even richer. Thank you, Mr. Chairman.